So we can establish a couple things here about tax liens. We know this. We know that tax liens are issued by counties to enforce the payment of delinquent property taxes. We know that that tax liens themselves do not convey property ownership. In other words, purchasing a tax lien doesn't mean that you somehow own that property. Really, a tax lien is more like an IOU, but the basis or the IOU has a guarantee with the property standing behind it. So again, there's no property ownership there unless the property owner doesn't pay that back within the redemption period, and then they actually actually give the investor the ability to foreclose. We know that tax liens have redemption periods that are given to the actual property owners, so they have a certain time period in which they can repay back that delinquent amount. We also know that tax liens pay out a set rate of return, and that rate of return can range anywhere from about 10% on up to about 25% or higher, depending on which state you're investing in. We know that they're sold through county tax sales, and we know that they give the lien holder foreclosure rights after the set redemption period has expired. Now let's talk for a minute here about tax deeds. States that sell tax deeds do things just a little bit differently than states that utilize a tax lien system. Steve, if you want to explain to them a little bit more about what a tax lien is, I'm sure they'd love to hear from you.
Absolutely. Well, a tax deed is going to be a little bit different. You know, Shay talked about it earlier as property acquisition. And that's really what it's going to come down to. The difference between a tax lien and a tax deed is the county is just going to go ahead and hold that certificate themselves. They're not going to sell that certificate to investors. They're going to hold that until the redemption period is up. And at that time, they're going to go ahead and offer that property at the auction to be purchased. Tax deed sales, when you're attending a tax deed sale, you're actually buying a foreclosed property. And so when the bidding is going to be a little bit higher since the property owner may not have paid back every single year. So if a property owner didn't pay back property taxes for 3 years, instead of you investing 1 year's worth of back taxes, the bidding's going to start at 3 years worth of back taxes, but you're going to be owning the property itself. Similar to a foreclosure sale, we hear a lot about the foreclosures going on right now. The difference between a foreclosure sale and a tax deed sale is the county's foreclosing because this investor or this homeowner has not paid back the investment, not paid back their taxes for a period of time. And so really when attending a tax deed sale, you're going to be acquiring the property itself.
Excellent. So basically, I mean, tax deeds totally convey property ownership. In other words, purchasing a tax deed is purchasing property outright. It's an actual deed to a property. It's just like the county waits out the redemption period that property owner has, and then they just foreclose on the property itself and then sell it to investors at a tax deed sale.
In fact, Shade, we went to a tax deed sale this week.
Yeah, we did. We attended a tax deed sale this week, and there are different auctioning systems that are out there and that are used. We're going to get into exactly how counties sell tax liens and deeds through the auction experience. If you can learn how these auction systems work, then you can pretty much walk into just about any tax lien or deed sale and feel comfortable with the terms they're using, as well as the way that they're actually selling these liens or deeds off. Now, some of the benefits quickly of tax deed investing is, number one, it's property acquisition outright, which means that it's free of encumbrances such as a mortgage, so you don't have to worry about anything that existed there before. The county has already foreclosed on this property. The bidding, now Steve mentioned before that you can be looking at multiple years worth of delinquent property taxes. The bidding is going to begin at the cumulative total of all the delinquent taxes, penalties, and fees. So in other words, if there's a 4-year redemption period, you could be looking at 4 years worth of delinquent taxes and penalties and fees. So in other words, you might see a starting bid that is 5% or 10% of what the fair market value is. Like I said, the bidding will begin from there. However, like we said earlier, there are properties out there that will sell for 10% of the fair market value. That is something that commonly happens at tax deed sales. In fact, when Steve and I attend a tax deed sale, we're not interested in anything that we don't think we can get for 40% of the market value or under.
You know, in fact, sometimes, occasionally, we've come across tax deed sales where good properties, good valuable properties, weren't even paid back for the delinquent taxes, and there is opportunities out there in some tax deed states to contact the county directly and find out if they do have any leftover properties and purchase them just for the back taxes.
Exactly. In fact, Steve touches on something there that we're going to get into in detail, and that is that a lot of times with these tax sales, they don't sell everything that they have available. And if that's the case, then they have leftover properties, which means that they still have revenue that they haven't been able to collect. Many counties will actually sell those liens in a process called over-the-counter tax lien investing, or even over-the-counter tax deed investing. So this is important to know, because what it means is you don't have to wait around for a sale to take place. You can actually contact counties directly, or you can even do it online using the internet. There are some counties that have thousands and thousands of tax liens on the books still that have not been purchased because I guess really that can take place for a number of different reasons, and we'll get more into it here as the discussion progresses. Now, there's one more system that's used in the United States to enforce property taxes, and it's kind of a unique one. We've termed it redemption deeds, although you'll hear it maybe referred to as hybrid states. Hybrid state's probably a good way to describe it. I think redemption deed's a little bit better way to describe it, though. Redemption deed is similar to a tax deed, and you're actually looking at property acquisition, so it's an actual deed to a property. What is different about a redemption deed is that it's like a tax deed, but it has a redemption period associated with it. So I think Texas is probably one of the best examples of a state that utilizes a redemption deed system. There are some unique advantages to redemption deed systems for investors, and because of that, some of the highest rates of return that you can find anywhere in the country can be found in Texas and some other states that utilize a similar system. Now, the reason for that is because they pay out a high rate of return. And it's also, as far as the rate of return goes, I guess the best way maybe to do this is to explain exactly how Texas works. If you were to purchase a redemption deed from Texas, you would show up at an auction and you would purchase the deed to a property outright. So let's say that you spend $50,000 for some type of a single-family home. Well, at that point, you are the physical owner of the property. The only thing that's different is that the property owner actually has 2 years to pay back the delinquent amount, including a substantial rate of return that would go to you if he or she does pay back that amount. Texas counties have a 25% flat rate of return for properties that redeem, and that's basically on a yearly basis. Now, that's a flat rate. So when we're talking about a flat rate versus like an annual rate of return, we're talking about 25% flat on your money.